Okay, so the purpose of this video is to explain to you how to use the simplest of the three models that we're going to be sharing. So this model I use in my Master's in Tax class at San Jose State, and students use it to do homework problems. Again, this is the simplest of the three. This model is very simple. So you might want to use this for a small ESPC provision, something that has very little going on in terms of anything outside of kind of normal current and deferred activity. But if nothing else, this is quick and easy. You can do a small provision on this very fast. Okay, so to orient you, you can see at the bottom of the page there's a half a dozen tabs to this Excel workbook. And I've ordered these in the sequence that you'll normally need the tabs for purposes of doing the provision. Okay, so the payable tab is first, mostly because this is where you're going to enter data. Okay, and then as you get to the far right-hand side of the workbook, you'll see footnote tabs, and those tabs are largely going to be automated in terms of the data rolling from left to right in the Excel workbook. And by the time you get to those right tabs, it should just be summarizing data. Okay. So I think the best way to show you how to use this template is to do a basic provision. And so we're just going to create some simple facts, and I'll input the provision along the way, and you can see how the provision model works. Okay. So before I jump into the numbers, let me just kind of quickly explain how this tab that you're looking at works. You can see that the schedule is split into two, and this section I'm going to write on the screen here just briefly. So this section right here, this is my federal section of the provision, and then over to the right is my state section. So what you'll see with both the federal and the state section is that I have 4 columns. And the idea behind those 4 columns is that each row should be a balanced journal entry, because you can think of each row as its own journal entry in a sort of way that we would book to complete our provision. So we're going to go row by row and input data in a payable sort of format, but you're going to see that it's going to populate a balanced entry on every row. Okay, and the one thing I would call your attention to at the very beginning is this model is set up in debit-credit format. Okay, so consistently throughout the model, it's debit and credit. So as you're thinking of, is a number positive, is a negative, know that the answer is debit-credit. Okay? All right, so let's assume that we're doing a provision that has, it's for a company that has 1,000 of PBT, okay, has 1,000 of profit. So if we were going to do a provision for that company, we would start in our PBT line for the federal payable, and if we had profit, we would enter in a credit, because we're going to have a payable of 1,000. Okay, we're not going to have a payable of 1,000 per se, but we'll have income of 1,000. So that line will be entered as a credit to the payable, because ultimately that profit's going to drive an increase in our tax liability, and it's going to drive an offsetting debit in the provision column, because that income is going to drive a tax expense. Okay, and so like I said a second ago, the row for PBT balances, and if all we had was PBT, we would have a balanced provision. Right? You don't need a template to calculate that, but you get the idea. So we have 1,000 of PBT, so that's our first row. Let's say then we also have meals and entertainment, which is a non-deductible expense, and let's say it's 50. Okay, so if it's a non-deductible expense, that means it's going to increase our payable. So I'm going to put that as a credit. And because a meals and entertainment add-back is going to be a permanent difference, that permanent difference will increase my provision, and so I have a debit to my provision of 50. Okay, and you'll see that the way this template is working so far is that if I just input the payable number, the provision number automatically knew what to do. But don't be, I mean, this model is so simple that if for whatever reason that linking isn't working right, just just type it in or relink it yourself. I mean, this Excel workbook is not complicated at all, and you shouldn't be afraid of breaking formulas or changing formulas. Okay, so we have a $50 meals and entertainment add back. Now let's say that we have a $200 depreciation deduction. Let's say tax is bigger than books. So if tax is bigger than books, that means my payable is going to go down, which means I have a debit to my payable. But because that's a timing item, there's not a provision effect. Instead, there's a deferred effect. And so that extra tax depreciation I'm claiming now, I'm going to see the opposite effect in the future. And so I'm going to credit my deferreds, and that's why this balance is a credit. So if, let's say that's enough. I have PVT, I have a perm, and I have a temp. Okay? And as I mentioned before, you can see that every row in the schedule is a balanced journal entry. So if we went further down in the schedule, you can see that there's no tax rate. So I'm going to type in the tax rate of 35%. And now on this row, I have a balanced journal entry. Right, so if I sum that across, that's going to sum to 0. So the last assumption for now, let's assume that I have a $20 R&D credit. So a credit's going to reduce my tax, so it'll be a debit, and because that's not a temporary item, it's a provision effect, I'm going to have a credit to my provision of 20. Okay. Alright, so let's stop there and show you how the model works. So if you pause there, what this schedule is telling us so far is that my tax liability, my payable, that's going to be this $278, so I owe $278 of tax. My change in deferreds for the year is 70, meaning I have a net credit to my deferred tax balance of 70, and my provision is a debit of 348. It's an expense of 348. Okay, so in effect, this schedule has calculated your provision for you. But let's go through what the other tabs are going to say, so you appreciate what the flow is. So the next tab is the deferred roll forward for the federal deferreds. And keep in mind we haven't added any state tax assumptions yet, so we're just trying to keep it easy. So if you remember from the first tab, we had one temporary item which was depreciation, and that was this guy right here. And we said because we had a tax over book deduction in our payable, that must mean we have a deferred liability in our deferreds, and that's what we see here. So remember, this is again debit credit, so this depreciation temp item is a future taxable difference. Okay, so this schedule is simply rolling forward from the beginning of the year to our end of the year. It's rolling forward our deferred activity, right? So it's going to go left to right. So in this section, I marked the red arrow in, that's our roll forward. These sections are going to map those deferreds between current and non-current. Okay. There's a final section over here on valuation allowances and provision and APIC, and I suspect that most of you are not going to need that, so you could ignore it for the moment. Okay, so what this section would tell us is that at the end of the day, our deferred liability increased by 70 and our ending balance is 70. So this is such a simple example that that seems obvious to you, but once you populate this thing with a current balance and you have to do a true up, etc., you'll see that the schedule will fill out and become slightly more complicated. Okay, and of course that 70 of net deferred movement, that matches the 70 that's in that middle red circled item from the payable tab, and that's supposed to be how it works. Okay, so now moving on to the accounts tab. I skipped the state deferred roll forward only because we don't have any state assumptions yet. So in this account analysis tab, this is going to tell us how we should book our provision based upon the first 3 tabs of the workbook. And as you can see, this thing is automated so that the journal entry just flows from the prior tabs. We didn't have to do anything. And the only journal entry that's showing up is this row. And these numbers might even look familiar to you because they were the same numbers that were at the bottom of the first tab. Okay, and that's exactly where they're pulling from. If I looked at the underlying formulas, you can see it's linking to the payable tab. Okay. So, for a company that needs to book a simple provision, this tab is going to pull the relevant balances in the different accounts that you need, and then out will come an adjusting journal entry. And of course, if the company has something recorded already, you'll have to compare, these balances here to what the company already has on their books. And just like with the payable tab where I said everything was balanced, you'll see on this tab there's a total. Everything needs to balance on this tab as well so that we book a balanced journal entry. Alright, the last tab I'm going to show you is the Footnote Rate Rec tab. So this tab is going to give you two key tables that will go in your footnote. The first table is the summary of current and deferred provision. Okay. And so if you, again, remember those numbers from that payable tab, this is my current liability that came off that third column. And so the current liability will in turn become my current expense. This is my movement in deferreds. So remember, I built a DTL. So if I built a DTL, that means I'm going to have a deferred expense to balance that out. And then the 348 will be my total provision. Okay. So that table is my summary of current and deferred, and it does it by federal, state, and then foreign. We don't have any foreign in this provision model, but if you had a simple foreign expense that you needed to populate into a table, you could just kind of hard code straight into this tab. Okay, then the last thing down here is the rate reconciliation. So from a rate rec perspective, again, these numbers are populated or pulling from the populated data on the first tab. And so you can see that we would have expected a 350 provision if we had 1,000 of PBT, but our 348 is what we ultimately end up with. And we have two differences. Difference number one is the meals and entertainment item, which is an increase to our provision. And then difference number two is our R&D credit, which is a benefit. And so this isn't always going to work in terms of being automated and just click like this. But because the adjustments we've made are so simple and they're already contemplated within the workbook, the tabs all talk to each other and everything flows seamlessly. So of course, if you have a different type of permanent item, let's say in your permanent section it's not listed here, and you want to create a row, that's fine, but that just means that of course you're going to need to create a row in your rate rec so that the two things are syncing together. Okay? So that's the federal provision, or the use of this template using a federal provision. With the state, you can see that this box right here, that cell's empty, and that's on purpose, only to kind of turn off the state provision for the moment. If I turn on the state provision, I'll just put a tax rate in there, you'll see that everything linked for purposes of the state provision. And that's going to populate the state deferred roll forward. It's going to populate a new row on the accounts tab for the state activity. It's going to populate the state column of the current deferred schedule, state line for the rate rec. All that stuff's going to flow automatically. And the Fed effective state can be kind of tricky. You'll see that that's contemplated here, and I'm not going to spend time in the video going through the mechanics of that. This is set up for a state where the deduction for state taxes for federal purposes is deducted on a current basis. But again, you can go in and change these formulas as much as you like to accommodate whatever your facts are. This is just a really simple approach, that's all. Okay, so that's the model, and the one that we'll share will be blank, but just by virtue of seeing the video, in theory, you see how it works.